Sam Stovall is with me, Chief Investment Strategist at CFRA Research. He joins me now. I mean, that's what's happening here, isn't it? People have had it's not dot-com boom and bust. These companies have got real customers and real money and real revenues, but they can't justify that price.
Absolutely. Well, when you look at what's been going on, we've been seeing a revision, a reassessment of the valuations for these companies where expectations were just so high. But now, because we're expecting to see a softening in GDP growth in the first quarter, because the Fed is raising interest rates, what we're expecting to see is therefore possibly a reduction in the earnings, not only for the coming quarter, but for the coming year.
Right, but the reduction in earnings, I mean, and irrelevant necessarily to the Facebook issue of Meta, but the reduction in earnings don't justify 20, 25, 26% falls in prices. So why are they falling so brutally?
Well, I think because what has happened is, as the Wile E. Coyote analogy shows, that there really was not enough support underneath them based on the overly optimistic assumptions that essentially, growth was going to continue to go on forever. And that when they actually told us that no, revenue growth is likely to be between 3 and 11%, but the street was looking for something closer to the mid-teens, then you have nowhere to go but down. And also, when you see the prospect of higher interest rates, that too is putting pressure and causing the coyote to fall even faster.
So for investors who have to make decisions, it's almost impossible in this environment. I mean, we still accept, for instance, this is the conundrum here, that rates are going up. Economies might slow somewhat. We're not looking at a recession. Unemployment is still low. Inflation will come down. One assumes, and I can see a lot of the logic here, Facebook, Netflix, they must regain some of that value, surely.
Oh, they will, just as the stock market regained its value back on October 19th of 1987 when it lost 22%. We ended up recovering that fairly soon thereafter. So I think what's happening is investors are saying, okay, the company is not going to earn $357 as or have that be a price target, but rather maybe $294. Earnings are going to go up by maybe 14% in the coming year, not at some astronomical number that had been anticipated. So essentially, the angle of ascent has been readjusted. It's still higher, but at a much more reasonable pace.
So when we look at the Ackman purchase of $1 billion in Netflix last week, because the argument goes, Sam, you're still paying your $20 a month to Netflix. I'm still paying my $20 to Netflix. Maybe it can't justify $700 a share, but certainly 400, 500, and it's down at 410. This isn't buy on the dips. Is this a time for investors to make judgment calls?
I think investors do have to make judgment calls. We've been seeing waning momentum in the growth group. By that, I mean communication services, where you would find Netflix, where you would find Facebook. Also a readjustment in consumer discretionary, where you would find Amazon, as well as technology. These groups have been slowing even prior to the market's decline that began in the beginning of January, essentially saying that maybe it's reached its peak for now, and that we want to digest some gains, take some profits. So right now, I think investors have to generate a shopping list. What stocks do they want to buy at what price, and not allow their emotions to become their portfolio's worst enemies?
Sam, that's fantastic. Thank you, sir. I shall write that down. I shall write emotions, worst enemies, and write a shopping list. Good idea. Thank you, sir. Appreciate it.